Imagine a small, ambitious crypto project with a market cap of just $300 million quietly amassing enough mining power to hijack a privacy giant like Monero, causing chain reorganizations, price plunges, and heated debates across the ecosystem. Is this the dawn of a predatory parasite draining life from established networks, or a bold whistleblower exposing cracks before hostile forces shatter them entirely? Welcome to the enigma of Qubic, a force that could either erode crypto's foundations or forge them stronger. Now, Qubic isn't some fly-by-the-night fork trying to make a quick splash. This project has deep roots, tracing back to 2012 with early IOTA and NXT development, led by none other than Sergey Ivancheglo, one of IOTA's original founders. Since 2018, it's grown quietly in the shadows, building a unique platform that merges blockchain with AI. Now, at the center of Qubic's design is a concept called useful proof of work, which is a twist on traditional mining, where instead of burning energy on meaningless math, miners contribute to real-world AI training through a decentralized model named AI Garth. Now, that work simultaneously secures the Qubic network through its quorum-based consensus mechanism, efficient, feeless, and smart contract enabled. But what's really caught the world's attention lately isn't its tech, it's its tactics. Qubic has begun redirecting its growing mining power toward outside proof-of-work chains. First Monero, next possibly Dogecoin. The goal? Not to destroy them directly, but to outcompete them economically, mining their coins, selling them off, and feeding the profits back into Qubic, burning tokens, rewarding its own holders, and boosting its price, all while drawing massive attention, both praise and outrage from across the crypto world. So here's the central question that we're exploring today in this video. Is Qubic a dangerous parasite extracting value from hosts without giving anything back? Or is it a provocateur, serving as a kind of fire drill for networks that might otherwise fall prey to far more malicious attackers? In a decentralized world without gatekeepers, it's often the most disruptive forces that reveal our deepest vulnerabilities. The challenge is knowing whether to reject them or learn from them before it's too late. Qubics methods aren't just unconventional, they're intentionally provocative. Instead of launching coordinated 51% attacks or trying to break into networks with brute force, Qubic takes a different approach. It exploits a system that already exists by offering better mining incentives. And in doing so, it exposes something uncomfortable about proof of work. It's not just about security, it's about economics. Back in August of 2025, Qubic made its first major move by targeting Monero, a leading privacy coin known for its resistance to surveillance. Now, within days, Qubic's miners managed to command between 28 and 34% of Monero's total hash rate, so not quite a 51% attack. But that was enough to trigger a 6-block chain reorganization, essentially rolling back recent transactions and orphaning over 60 blocks. The result? Confusion, panic, and sudden loss of confidence in Monero. Now, in total, Qubic mined 517 Monero, worth around $141,000 at the time, and immediately dumped it on the market in exchange for USDT. Half of that value was used to reward Qubic token holders, and the other half, it was burned, permanently removing 33.5 billion tokens of Qubic from circulation. Now, that single move triggered a 57% surge in Qubic's price and a simultaneous 15 to 28% crash in Monero. From Qubic's perspective, this was a success, a real-world demonstration of its core argument that existing POW networks are vulnerable not because of broken code, but because of predictable economic behavior. And they're not stopping with Monero. Public statements and cryptic posts from Qubic's founder, also known as Come From Beyond, suggest that Dogecoin is next. With Doge handing out roughly $3.2 million in mining rewards every day, the incentive is massive. Redirecting just a portion of that towards Qubic burns and token bonuses could send Qubic's price soaring again and further destabilize another major network in the process. Now, Qubic isn't hiding these intentions. In fact, they've been baked into the project's white paper since the beginning. On page 14, for those of you who want to do your own research, the team explicitly critiques traditional proof of work for being wasteful and short-sighted. They argue that the future of mining should serve a dual purpose: securing the network, yes, but also training powerful decentralized AI models like their own AI Garth. So instead of brute force attacks, Qubic is conducting what some call tech demos. Others call them market-driven invasions. But no matter the label, the message is clear. Qubic is forcing proof-of-work networks to look in the mirror, and what they're seeing isn't always flattering. To many in the crypto world, Qubic isn't some bold innovator. It's a parasite. That's the accusation leveled by critics who see its strategy not as a clever stress test, but as pure value extraction. It doesn't contribute to Monero. It doesn't improve Dogecoin. It doesn't build on the backs of these networks. It feeds on them. And in return, it offers chaos. So let's break that down. Qubic's economic flywheel is simple. It mines coins like Monero, sells them on the open market for USDT, then uses that liquidity to buy back and burn its own token. That does two things at once. It inflates Qubic's value, sometimes dramatically, and deflates the price and confidence of the networks it's targeting. I mean, case in point, after the Monero event, Qubic rallied by 57%, and Monero, on the other hand, plunged as much as 28%, with over $140,000 in coins mined and dumped in a single week. Exchanges like Kraken temporarily paused Monero services, community trust took a hit, and discussions about forking the entire network sprang up almost overnight. And this wasn't an accident. Again, Qubic's white paper and public statements spell out the plan. They've positioned themselves as a kind of economic predator, not breaking the rules, just exploiting the incentives those rules create. Like the vampire tax we saw in DeFi, where protocols like SushiSwap siphon liquidity from Uniswap, Qubic is siphoning hash rate, not through hacking, but through better pay. It's capitalism in its rawest form. And that's what makes it so controversial, because the big question is, where does this end? If Qubic succeeds in pressuring Monero and Dogecoin, what's to stop them or someone else from targeting Bitcoin next, or Litecoin, or any other chain with open mining incentives and no built-in defense for this kind of coordinated economic pressure? Even Qubic's own supporters admit that the model depends on fresh targets. If Monero forks away or changes its mining algorithm, as some developers are already discussing, Qubic loses its leverage. If too many communities reject this experiment, it risks being dismissed as a pump and dump with no long-term foundation. And then there's the social cost. Twitter is full of backlash, some calling it a Trojan horse attack, others labeling Qubic's developers as parasitic loons. The rhetoric is strong because the implications are real. If every protocol is fair game for value extraction, trust in open participation erodes, innovation stalls, and regulators start circling. And that's the fear, that Qubic is not helping the ecosystem evolve, but it's actually could be accelerating its fragmentation. In August 2025, Qubic controlled up to 34% of Monero's hash rate. It didn't launch a double spend, it didn't destroy the chain. Instead, it reorganized a few blocks and orphaned 60 others, enough to show what's possible when a well-coordinated, profit-motivated group decides to test the boundaries of a proof-of-work chain. And that's the key. They tested, not attacked. At least not yet. The reward, over 500 XMR mined, half sold for stablecoins, half used to buy and burn Qubic, but the bigger payoff may have been what came next. Monero's developer community sprang into action. Discussions around detective mining, fee structure adjustments, or even a pivot to proof of stake surfaced almost immediately. You could argue that's proof of strength, not weakness. In fact, this kind of controlled disruption might be exactly what proof-of-work chains need in an age where threats are increasingly sophisticated, from state-sponsored hackers to quantum computing. If Monero has been blindsided by a hostile entity with no interest in disclosure or restraint, the damage could have been far worse. And some might be able to say that Qubics model does offer innovation. Their useful proof-of-work concept isn't just a marketing term, it's a tangible upside from traditional hashing. Miners contribute to training a decentralized AI model, again named AI Garth, effectively converting idle compute power into machine learning progress. So instead of wasting electricity on random hashes, Qubic is channeling energy into something productive and then leveraging that compute to challenge other networks. It's a radical reframing of what mining can be. Supporters say this approach injects evolutionary pressure into an ecosystem that's grown complacent. Just like Ethereum used 51% fears as a justification to move to proof of stake, perhaps Monero and Dogecoin need Qubic to push them towards overdue upgrades. And the data supports it. Monero's hash rate was reclaimed by August 16th, just days after the Qubic demonstration. The price recovered by 19%, exchanges resumed services, the community, though shaken, proved adaptive, and that's exactly what we want to see in this space. So the question becomes, isn't it better to be stress tested by someone playing by the rules, even if provocatively, rather than being caught off guard by actors who don't care about fairness at all? In this view, Qubic isn't a parasite, it's a provocateur. And in the long run, it might be doing crypto a favor. So where does all of this lead? If Qubic keeps pushing forward with this strategy, using useful proof of work to siphon mining rewards from vulnerable networks, the crypto ecosystem is going to have to reckon with both the damage and the growth it causes. Because make no mistake, the outcomes will be mixed. Let's look at the potential impacts on Qubic's targets first. For chains like Monero and possibly Dogecoin, the short-term pain is real. In Monero's case, Qubic's demonstration contributed to a price drop of up to 28%, with chain reorgs sparking temporary confusion across nodes and exchanges. If Dogecoin is next, as hinted by Qubic's founder, the risk could scale. Dogecoin currently pays out, again, around $3.2 million in daily block rewards. If Qubic can divert even a fraction of that into its own burn mechanism, it's a financial drain on the network that could shake confidence fast. But in the long term, the effect depends on how these networks respond. If they adapt by upgrading their consensus, adjusting their incentive structures, or building detection mechanisms, they come out stronger. If they ignore the threat or delay changes, they risk being labeled weak or outdated. In that scenario, Qubic's parasitic label sticks and maybe even serve as a warning to others. Now for Qubic itself. If momentum continues, it could ride this notoriety to a stronger position. After the Monero event, Qubic's token price jumped 57%, and token burns from extracted rewards like the 86 billion Qubic burned in Epoch 174 helped fuel a speculative frenzy. Some projections now eye 1/1000th of a dollar mark by the year's end. So we're still talking very small prices here, but Qubic isn't immune to risks either. Running this strategy isn't cheap. It takes significant computational power and real costs. Estimates range from $75,000 to $100,000 per day in infrastructure and operational expenses if they continue targeting high-profile proof-of-work chains. That's not sustainable unless the price of Qubic and its network usage grows dramatically. Then there's the ecosystem at large. A few more demonstrations like Monero's, and we could see major shifts in sentiment towards proof of work as a whole. On the one hand, this could accelerate innovation. More projects moving to hybrid or proof of stake models, better miner decentralization, more audits, for example. On the other hand, it could stoke fear, uncertainty, and doubt. FUD. It could push exchanges to delist vulnerable chains, discourage new developers from contributing, or even invite regulators to step in and scrutinize what's perceived as a form of hostile extraction. In short, Qubic's existence forces a dilemma. Do we treat it like an enemy to be eradicated, or a challenge to be answered? The answer to that question may shape how crypto evolves over the next few years, because if Qubic succeeds in sparking upgrades and preparing chains for future attacks, it'll be seen as a turning point. If it only leaves chaos and broken projects in its wake, it'll go down as a high IQ grift that poisoned the well. Let's look at how all of this actually played out in the real world, starting with Monero. On August 11th of 2025, Qubic made headlines by capturing about 34%, I think at the max, of Monero's global hash rate. That's not a theoretical figure. That's on-chain data verified through mining pools and node telemetry. Within hours, Monero's chain suffered a 6-block reorganization. Over 60 blocks were orphaned due to selfish mining, an attack that had long been considered unlikely because of Monero's randomized mining protocol. And yet, it happened. Monero's price dropped roughly 15% within 48 hours. Centralized exchanges, including Kraken, paused Monero withdrawals to prevent further risk. The ecosystem was stunned, not because the chain died, but because someone proved it could be destabilized without actually controlling 51% of the hash rate. And that someone wasn't a hostile government or an anonymous hacker collective. It was a public-facing crypto project with a GitHub repo and a mission statement. So how did Monero respond? Well, to their credit, the community didn't panic. Developers quickly issued memos confirming that funds were safe and that the reorg was limited in scope. They acknowledged Qubic's presence and opened public discussions about defensive upgrades. Among the proposed ideas, a new mining algorithm to increase randomness, detective mining to flag selfish behavior, fee structure changes to boost honest participation, and even early-stage talks about a hybrid proof-of-work, proof-of-stake model. Now, none of these have been implemented yet as of August 22nd, 2025, but they're on the table, and that matters. For all the damage Qubic inflicted, it also revealed a lot about Monero's DNA. The devs didn't flinch. The miners didn't bail. In fact, Monero's hash rate rebounded to pre-Qubic levels within 5 days, and the token price recovered roughly 19% by mid-August. That's not just damage control. That is resilience. But the story doesn't end there. This case now serves as a litmus test for how other proof-of-work chains might react. Dogecoin's community is watching closely. Litecoin's developers are already asking questions. Even smaller proof-of-work chains are now considering, could we be next? Whether you see Qubic as a parasite or provocateur, Monero's case shows that how a chain reacts may matter more than the attack itself. If a community can face disruption, adapt, and come back stronger, then maybe, just maybe, the attacker did them a favor. In crypto, there's no central authority to ban a bad actor. There are no bailouts, no referees. What we do have is the free market, and that means every community has the power to either reject or repurpose a disruptive force like Qubic. Some want Qubic gone, plain and simple. Monero developers have floated hard forking the protocol to render Qubic's attacks obsolete, possibly by tweaking the mining algorithm or introducing randomness that you, POW, can't optimize against. That's one option. Cut off the parasite's food supply. Others prefer a softer approach, essentially starving the incentives by increasing mining rewards for loyal nodes or implementing penalties for suspicious reorg behavior. A chain can neutralize profit-motivated takeovers without a full-scale fork. These are examples of what you might call immune responses, natural adaptations that evolve in real time. But here's where it gets interesting. Some projects are wondering if Qubic-style threats could actually be harnessed as organic security audits, like bug bounties, but in the wild. If Qubic forces a protocol to find and fix weaknesses, isn't that more useful than pretending those vulnerabilities don't exist? Think about it. Uniswap survived SushiSwap's 2020 vampire attack by innovating. It launched its own governance token, added LP incentives, and bounced back stronger. If Monero or Dogecoin do the same in response to Qubic, it's not just damage control, that's evolution. And then there's the wild card outcome. What if other projects start building their own Qubic-style stress testers? Not for profit, but as part of protocol hardening. What if these disruptive actors become the new standard in decentralized security? Now, of course, none of this works if the community doesn't engage. The worst case scenario isn't the parasite, it's apathy. If developers ignore the attack, or if users flee in panic, then the damage sticks. But if they fight back with code, incentives, or community coordination, then the system proves its resilience. In the end, the free market won't decide whether Qubic is good or bad. It'll decide whether Qubic is useful as a catalyst, an adversary, or maybe even both. So, is Qubic a parasite or a provocateur? The truth is, it might be both, and that's exactly why it matters. Because what began as a low-cap project built around an experimental useful proof-of-work model has now forced some of the biggest names in crypto, Monero, Dogecoin, possibly even Bitcoin in time, to stare directly into their own structural weaknesses. It's exposed mining centralization, economic fragility, and community readiness in ways no audit or white paper ever could. Yes, Qubic drained value. Yes, it triggered price drops, forced reorganizations, and sparked panic. But it also surfaced conversations we've been avoiding about the security assumptions we place in our favorite chains, about the unchecked reliance on hash power, and about whether decentralization can truly hold up under pressure. This isn't just a drama about one small project testing the big guys. It's a mirror held up to the entire crypto ecosystem, a reminder that our networks are only as strong as our ability to respond, not just to exploits, but to competition in its purest form. In a permissionless system, there are no gatekeepers. That's a feature, not a bug. It means bad actors can attack, but it also means protocols can adapt. And if they do, if they meet this disruption head on, then what looks like a parasite today might one day be remembered as the stress test that made the entire system stronger. Because in crypto, as in nature, sometimes parasites become symbionts. Sometimes disruption is just evolution wearing a different mask. Now the question is, will we evolve? And if you want to keep evolving with this space, grounded, informed, and ahead of the curve, check out learningcrypto.com. We break down the complex shifts in crypto so you can move with confidence, not chaos.